Good morning. It's a glorious Wednesday, April 30th, into the month. Zach Howard. Here's your morning market update. My go-to home screen here, investing.com. Got everything you need from a data macro standpoint here on the screen for free. Easy to navigate. So what are we looking at here to start? Commodities lining up with yields, screaming disinflation here now, screaming slowing growth, slowing inflation, looking through the lens of copper down almost 5%. Oil continues to be in the shitter, less than $60 a barrel. We're not counting gold because it is not a commodity, it is a currency. But as we line up bond yields, we see similar sets. Look at this 10-year continues to fall 4.15%. 3.6% on the 2-year. That's slowing growth, slowing inflation right there. Commodities, bond yields. You don't need to look at NVIDIA. You don't need to look at S&P 500. That is where the signpost is to. On to where the market is, the sideshow, which is the equity markets. Retail investors continue to buy the dip. They are not fazed by this backdrop of slowing growth and slower commodity prices as they look to buy the dip in the S&P 500, particularly those Bag 7 stocks. So after Liberation Day, institutional investors, those big money managers said, we're going to take down risk. We're going to reallocate to less beta names. Whereas the retail sector said, man, I'm not afraid. I'm going to keep piling in here. This is a chart S&P 500. It's still down around 8.5% for that Liberation Day post sell-off meltdown. It's regained some, but look, the up chart is still a ways away from recapturing that positive bullish trend. Gamma flip line where it goes from negative to positive in the S&P 500 to somewhere around 5,700, 5,800. We're getting above there. What is the catalyst for it to get there? Is the volatility. The volatility inside the market is going to determine where we go from here. We have big macro catalysts from both a earnings standpoint with those S&P 500 mega cap names, Apple, Microsoft, Meta, etc., reporting earnings in the next couple of days. GDP number here this morning in the US, and then a labor jobs data on Friday. So once those events come true and they are not as bad as potentially predicted, and volatility comes down, there's going to be a driven flow from those volatility control funds. If you see this blue line drop below this orange type line here, implied volatility versus realized volatility. When that realized volatility is still elevated, vol control funds that are driven just based on systematic buying and selling on what the volatility is doing, deploy or undeploy capital into the market. So we're going to see if this can make a run back to 6,000. If it fails here, it's a good chance we go back to where we were to Liberation Day on that S&P 500. Next up, real yields. Tying back to the beginning here, what yields are saying, slowing growth, slowing inflation. If you look at what CPI is currently, it's probably legitimately below 2.5%, but you got real yields well north of that still when you're looking at that 10-year yield of 4.5%. Donald Trump, say what you want about him, but the dude knows interest rates. He has played his entire life through the backdrop of managing the coupon payments on interest rates on his long-term debt. The ideal of long-term debt, whether you're a real estate developer or a government, is never to retire the principal. It's only to continue to service the interest on that capital, hoping that you continue to get inflation to see that inflationary pressures bring that asset up. The US government is no different than a real estate developer. They're never planning to retire $37 trillion in debt. They just need to be able to service the interest cost on it. With that, they need lower interest rates, lower real interest rates when it comes to what the economy is doing and how markets and Fed policy is. Gold is sniffing this out as it continues to make this run over the last 5 years, up almost 100% in real terms. If you look at something measured in gold, it hasn't gone up. It's a deflationary pressure, just like Bitcoin, 1,000% in 5 years. Looking at the price of McDonald's and takeout food menus over the 5 years, it reflects what gold and Bitcoin is saying. The currency is the relief valve. It always will be. Ultimately, debasement of the real purchasing power of the US dollar and all fiat currencies is the only way this monetary game continues to unfold. We can't have deflation in this backdrop. So real rates have to come down. That's what I got for you. I will see you soon. I hope you have a great day, and we'll see you later on.